Hi everyone, this is Arpad from Starpath Academy, and today I would like to give a detailed answer to a question that came up on buymeacoffee.com/Starpath Academy in the members area. A person who comments a lot, thankfully, and asks a lot of good questions. So I'm really thankful for him. Asked another really good question in detail. So if you remember, you can go under the post that is titled "Psychology of Panic and 5 Societal Strategies of Dealing with It." It was also a public post on YouTube, but on the post that is private, he has a couple of questions and comments, and I thought it would be really great if I could make a detailed answer in a video. Of course, running some thought processes and so on. And we have some disagreements, but it's really awesome that because we could then get to compare opinions and dissect the issue. So yes, so we've been talking about real estate investments on the channel and how they serve or can work for you during hyperinflations, as long as the political changes kind of don't go out of whack, I should say. But we'll see what happens. He's comparing, of course, gold and real estate. By the way, he's making an awesome assessment, always does, and it's really nice to see his comments. So and we are on agreements on many things now, and I actually agree to his assessment that during a collapse or a hyperinflationary situation, gold will outperform real estate. I don't have any doubts in my mind in that, right? And I have historical knowledge that of course happened during the Romanian high inflation, because as I told you, the examples, just small pieces of gold could buy you big real estate. Actually, real estate, when you see real estate charts during hyperinflations, they shoot up, but relative to other stuff, it's not that steep. It doesn't shoot up that much, right? What I like about real estate is that the debt that you have gets easier and easier to pay off. As long as the debts don't get restructured, it gets easier and easier to pay off, because the real term of it, right, the purchasing power of the debt you own on a real estate gets inflated away. Now, of course, I always tell that has to come with you being able to hold on to the real estate, because if there's a deflationary crisis and let's say you own a couple of rental units and you're not able to pay your mortgage, they will take it away even before we hyperinflate. And if we hyperinflate, right, but you are not able to pay your mortgage again because you can't find renters, because the renters are fleeing big cities or centers of big cities, it's no longer good, right? But to me, at least, it's a one step better than stocks, because it's actually real assets, right? So in case of major calamities, stock market shutdowns, electricity going away, it's still something that if you're smart about it, you can hold on, and hopefully hold on through the crisis to the other end and still have it, right? But actually, if you're smart and you know what you're doing, then you might be able to pick up real estate on the cheap during crisis. And I think that's what he alludes to, and perfectly fine. It's just let me prove his point first, and then give a couple of extra thoughts about why I still am pro real estate in some cases and for how long, right? So let's talk about that. So I'm going to share my screen here to talk about some numbers. Now, these are just thought processes and numbers to figure out what's going on and some potential situations. These are not actual numbers that you should rely on, but hopefully this will make you understand his point and my point when it comes to gold or real estate. So In this green bar here, there's real estate, and there's a down payment of $25,000, right? And then we put we need extra costs of like closing costs and other stuff. So let's take $33,000, and with that I'm buying $100,000 of real estate, right? Total house value. And you could use the same amount of money and buy gold price per ounce. Now actually coins, right? Not spot price. There's nothing that you get for spot price. And you get to buy 18 1-ounce gold coins, right? Instead of $100,000 worth of house. These are just theoretical numbers, especially for the house. I don't think you can buy anything for that. But let's say, and here's the fun part, hyperinflation starts, right? And so I'm going roughly by the Romanian numbers. Let's take, okay, you take 7 years, 5 years, whatever, and we count in doublings, right? How many times the price doubled. Now I told you roughly for bread and food items it was 13 doublings. House prices didn't go that high, of course. But so in this case I'm taking 6 doublings plus an extra 150% increase. Why? Because that is actually 100 times of its initial value, right? So doubling is an exponential function, and it adds up to 100 times. So let's say in a hyperinflation that house price has increased to $10 million, hyperinflated dollars, but now bread could be, you know, $10,000 or $8,000, whatever. We don't care. What we care about right now is comparing it to gold price. Now, gold price I calculated roughly from the Romanian inflation, or actually back from hyperinflation, how much it lost in value compared to real estate after hyperinflation. So these are somewhat realistic numbers. I'm taking 1,000th of increase, right? So that means it increased its original price 1,000 times basically. But we don't care about gold. We're now calculating everything in inflated US dollars. So that would roughly be about like the original amount plus times 1,000, which comes down to 33 million US dollars. So this buys 3.3 houses, right? So in hyperinflation, if you would have kept in this situation, this scenario, which is just theoretic situation, this would have bought you, if you would have kept it in gold, now you can buy outright 3.3 houses, whereas here you own the house, but you still have that, you know, 10 loaves of bread that you need to pay off in a mortgage that you had, which is the original amount of roughly 67 yes, $67,000, but that will be nothing and you'll pay it off, right? So these are the numbers. So what's shocking is that it's actually gold went up 10 times of the real estate, but you can only get 3.3 houses, right? And I calculated some other scenarios where gold, well, houses go up 200 times its value, gold 1,500 times, then it buys you 2.475 houses. Some other scenarios which are unlikely, but these would be like Weimar times, it goes and buys you 5 houses. Right, now it's actually also better because after hyperinflation you get to see which neighborhoods are somewhat still better, and there you want to buy houses. Whereas instead of you bought prior, you could actually, that neighborhood might be completely demolished during hyperinflation. Who knows? So to understand these numbers and why this is happening, actually let's take a look at the initial amount of 25,000, right, and calculate with the exact same amount, right? So let's say we cut out closing costs and everything extra, and we just calculate with 25,000, and then suddenly you realize, well, it's actually 2.5 houses, right? So it's even less because you're taking the less amount. So it's $25 million. And of course, this all was put together in order to demonstrate that it's actually 1/4 of whatever it grew, how much it grew faster by the original house increase price. right? And why is that? Because, well, you used leverage on the initial purchase of the house, but you did not use leverage on the purchase of the gold, right? So when you're purchasing a house, you're paying $25,000, but you're actually getting 100,000 value. When you're purchasing gold, it's 25,000, but it's just 25,000. You're not able to buy $100,000 worth of gold. So basically, initially, as long as gold and real estate are increasing at the same rate, you're still better off with house. But as soon as hyperinflation really kicks in, you're way better off with gold, right? So that's what we were demonstrating here. And here, if gold prices would be increasing just 4 times faster than house prices, then you would be exactly where you would start it. All right. So the initial leverage gives you an initial boost at first, but then as hyperinflation kicks in, gold will outperform your house purchase, your house increase, right? And now I just took some random numbers. Well, not random, they're from high intelligent people, right? So let's take a look at George Gammon's number, right, which says that gold price could go up to $50,000. Well, that means that it will increase roughly 26.4 x's from its initial value, while house prices could be only doubling, or 6.6x. It has to be 6.6x in order to catch up with gold price if you have a 1-to-4 leverage on the house purchase that you are buying. So now let's look at an exact example, what has happened to our family in Romania. Okay, so on another post, I wanted to answer a question posted by another member where we calculated roughly the current value of the homestead we have sold, measured, of course, the acreage and so on, if no improvements would have been done to the property since we sold it, the one that was roughly around 2 million Romanian lei, and now it would be 78,000 US dollars, right? Which would now buy roughly 1.3 kilograms of gold, right? That amount of dollars, right? And we sold it for how much? We sold it for 15 grams of gold. So out of that, you can recalculate what was the purchasing power of gold back then, and how much gold actually depreciated after hyperinflation in terms of real estate, right? So now we're calculating it back, right, from what it is currently back how much it fell, because that is roughly how much it rose during hyperinflation. Pretty simple. So what we're calculating here is I'm calculating the rate that gold rose faster during hyperinflation than the real estate price. That is why they were able to purchase that real estate with a couple of million Romanian lei, which was just a couple of grams of gold, right? And these are real numbers, real history. So, and then I calculated, well, that is 117, right? 117.511 is the rate that gold had to appreciate faster. So 117 times faster it depreciated compared to real estate. So roughly my calculations here were actually way off, right? Because I just calculated a 10 times rate of that. But, I don't want to assume something in what happens in a total collapse. I just wanted to assume something if the current printing goes on for now. So to agree with him, yes, you can get way better rates with gold than with real estate during a hyperinflation, especially if there are food crisis and that sort of stuff, because people will sell their house in order to be able to purchase food and necessities, right? However, those who are prepared for the crisis, they might still want to accumulate gold for the rest of the years of the crisis. So gold will have a different scenario. So now I want to take a look at some appreciation in real estate in just various random cities, right? And let's take a look at let's just say Atlanta. Well, I don't give advice, and I'm not telling you should buy real estate, especially not in big cities. I'm not a fan of it, but I'm just for observation purposes, we're gonna be taking a look at it at some points at some cities. So I'm looking at Atlanta, which roughly the median is 353,000, right? And the appreciation in just under 1 year was 16.16%. Birmingham is, wow, that's cheap, 93,000, and then but the appreciation was 23%, right, on the house prices under just 1 year. Huntsville is 22%, and the median is 250. And then let's just take a look at New York. Home values is 733,000 US dollars, but the appreciation is just only 5.6% in this last year, right? So now you know where people are moving in or moving out of, and where it's already peaking in the market. Of course, I'm joking. I'm not making predictions, but you can see on this chart that it's a more cyclical market. It has its ups, but you never know when it might pop, right? But it's still going up, right? It's still going up. It's not just not at the rate of let's say Huntsville, right, or Birmingham, or Atlanta. So these are just random cities I picked. Okay, but now actually I wanted to play a little game with you. Okay, so because it's nice, you always have, right, a vision 2020 looking back, but let's say you're in 2014, 2015, house prices are crazy, you should not buy, you should not buy, you should not buy, this is crazy, things will fall, things will go down, it will definitely go down, nobody has bought any, you're crazy for buying house, you're crazy for buying house, and up, and there we are, right? So that's how market works, right? It's easy to make an assessment here. So I'm saying that if they print money as they have been, that money will go somewhere, and it went into crazy places, from NFTs to a lot of crazy crypto projects which are totally crazy, right? And a lot of money have also went into real estate, and before it pops, it might go into a melt up mode, right? Because when we're talking about wealth cycles, it's people have these nice charts how the cycles change, theoretic charts, but actually it goes like this. It goes up, way up, complete bubble mode, and then it crashes, right? But that time frame, you don't exactly know how long it will take, right? And I'm saying that, let's say you have bought a house in Birmingham. Let's just say Huntsville. Okay, Huntsville. So you bought a house in Huntsville a couple of years ago, right? And now it increased in price 22% just this last year. So the reason is, when I'm saying that, since you bought it with leverage, let's say you had 10% down or 20% down, let's say you use the leverage of 5x, that 22% is way more than 100% increase. And what you can do with that now is you can pull it out with refinancing. So you refinance this house that you just purchased a year ago or 1.5 years ago in Huntsville, and what you get to keep is actually both of these, right? You both keep your $25,000 because you refinanced. You did not lose the house, you just did refinance. Somebody's still paying your rent, right? And now you got that money back and you still get to purchase some of that gold. Right. Now, of course, this is very risky because you're pretty much, and I agree with him, you're buying top of the market, but top of the market was every single month closely for the last 2.5 years. It was always top of the market, right? Same with stocks. So if you're waiting on gold and you have a lot of gold, then you will do well during hyperinflation, but we're not in hyperinflation yet. In order for that to happen, most likely a crack-up boom will happen, right? So in this chart, what we were looking at, there's a lot of money to be made right here, right? And who knows how high this will go. But this is risk. This is risk. It's not for everyone. Right? So you have to understand that. My portfolio would be totally different if I had 10 million US dollars, right? I would not necessarily have 10 million US dollars in real estate. Of course not. Maybe 80% of that would be in gold because I still have $2 million that I can live off of and for almost the rest of my life the way I live, right? But I don't have that amount of money. If you do, maybe you should buy me some coffees, but I don't. I don't. A couple of years ago, just less than 10 years ago, I had nothing to my name, basically. So I needed to play the catch-up game, as many other people in the roughly in my age group, right? Because we did not have all those good years. We started off with 2008 and the crash. Even if we had something that was lost. So a lot of people are playing the catch-up game, and it will it will backfire at some point. But the thing is that how fast you can pull your money out before this goes down, and this will most likely go down, if not in dollar terms, it will go down in real wage terms, which the commenter did specify, and I completely agree. Eventually, wages have to start rise, or this will have to come down. Or, what we didn't think would happen is the big mammoths, basically new branches of the government are popping up, like BlackRock and other companies, and buying you out of the market. And it can happen. It has happened in Eastern Europe, and it's still happening. Real wages in Eastern Europe and many other markets are way lower than, let's say, the average wage in the US, right? So, but the house prices are pretty much almost US house prices. So that means there are the possibility for someone from Eastern Europe, the ability for them to own a house is even lower than the expectation or the possibility in the US, which tells me that a lot of you, new investors are gonna still put up with higher prices and not owning property, because that's what people, especially young people, are doing in all of these other countries. So you will be left out on the opportunity to purchase a house because of these big buyers and because of all the money printing that's going on, right? And instead of at least trying to buy one house, a lot of money is being pushed into paper assets, which is even riskier, from my point of view, especially when it comes to options and trading with leverage. So my point is that gold is not an investment. Gold is not risky. Gold is an insurance policy. But you can just sit on the insurance policy and wait it out, and then something will happen, something will pop, and you can make a lot of money. But during that time, if you want to be able to accumulate faster, from my point of view, stocks is too risky. Crypto is a lot of speculation. So what are you left with? At least owning assets or houses, as long as you have enough cash in order to withstand a deflationary event, it's still better than owning equities, right, or bonds or whatever, because it's at least it's real, and as long as you can keep it, it's better than having paper. Now granted, it's not safe. It's not safe. Anything with leverage is not safe. So at least have your own house where you are living paid off, right? But then you can treat other investments or rentals as investments with risk that you might lose, right? And in order to cover those losses, you need to start accumulating gold and silver and precious metals that don't have risk. So you're playing on the risk side, and you're playing poker. But as you are winning, while you are still winning, what you need to do is take the chips off of the table and collect them. So it's not always one or the other. You know, when we're talking about that, I was actually making a video about this, that we're taught to be thinking in a binary mode, that okay, well, this or that, or you know, if someone from the other party comes, you just argue with them and shout and fight. You have to have a more holistic view and see where the risks are, what is still a good market, what is no longer a good market, what is the appreciation, and based on how much money you have, it will be the portfolio percentage wise might be very, very different, right? So for me, you know, not owning anything a couple of years ago, it's a very different situation, as if, you know, if somebody would have a lot of money and actually is 60 or 80 years old. That percentage of how much gold, silver, Bitcoin, crypto, whatever real estate he or she would own would be way, way, way different than what my strategy is, right? So that's what I'm saying, that you have to understand. You have to work it out for yourself, because if you have just $5,000 to your name, then maybe your guns and ammo in your portfolio is a huge percent, you know. Maybe whatever ammo you own is like 10% of the portfolio. But if you own like $1 million or $10 million, maybe 10% for guns and ammo or food would be too much, right? Maybe not. Maybe not. So that's what I'm saying. It's not whether one or the other is the best. What is best for the current time with a specific risk for you, and based on what you expect and roughly when, right? Because if a hyperinflation melt up comes, it's a very different situation. If a hyperinflationary event just happens without a stock melt up, it's very different. And if it's a deflationary situation, almost everything gets wiped out. So it's very, very different. The key is to have at least some type of physical assets that you can cover. Yes, hopefully without any debt. Yes, hopefully without leverage. But in order to a lot of these young people to catch up, they might not be able to do so without that. And I think that will be, for some, the demise of them. Alright, so I hope I gave you an answer with some numbers and opinions, but of course I'm always open to listen to your opinion and you know, update the models. So be sure to like the video, subscribe to the channel, and thank you very much.